All right, today we're going to crack open the money machine. We're talking about the Federal Reserve, an institution you've definitely heard of, but maybe don't fully get. We're going to see exactly how it runs your world. So let's just jump right in with a question that gets to the heart of its power.
Think about it. Who is the one person out there who can mess with your mortgage, your savings account, even the price of gas, all with a single decision? Is it the president? Nope. Some big shot CEO on Wall Street? Not even close. The real answer might surprise you.
The answer to that question isn't a politician or a titan of industry. It's this man.
This is Jerome Powell, but everyone calls him Jay. He's the current chair of the Federal Reserve, which is basically the central banking system for the entire United States. That means he's the guy in charge of the nation's money, and trust me, his decisions create ripple effects that touch every single one of us.
So he took over the job in 2018. But here's the kicker, the really surprising part about him. He's the first Fed chair in over 40 years who doesn't have a degree in economics. Nope, his background is in law and investment banking. Now, people debate this all the time. Some say, how can you run the economy without being an economist? While others think his real-world experience in finance is exactly what the job needs. It's a pretty unique resume for the person holding what is arguably the most powerful economic job on the planet.
Okay, so Jay Powell is the guy pulling the levers of our money supply. But to really understand that power, we need to zoom out for a second and ask a way more basic question about the very thing he controls.
It sounds like such a simple question, right? But it's actually super important. Before we can get out of the Fed manages all this money, we first have to agree on what even is money in the first place.
At its most basic, money is simply anything that a group of people agrees to accept as payment. And you know, throughout history, that has meant some pretty wild things. We're talking salt, feathers, animal pelts, even giant, heavy stones. At the end of the day, as long as we all agree it's worth something, it can work as money.
Of course, you can probably see why feathers and giant stones aren't the best options. For something to be really useful as money, it needs to have these 5 qualities. You got to be able to carry it around, break it into smaller pieces, it needs to hold its value, last a while, and really importantly, it has to be hard to fake. These are the exact reasons we eventually landed on things like coins and paper bills.
So this whole evolution, from stones to paper, eventually led countries to create a special institution just to manage the whole system. And for the US, that institution is our central bank.
So why was the Fed even created? Well, before 1913, the banking scene in the US was basically the Wild West. It was total chaos. Banks were failing all the time, different places had different kinds of money. It was a mess. Then a massive banking panic in 1907 almost brought the entire economy to its knees. After that, Congress finally said, okay, we need to fix this, and created the Federal Reserve to bring some order and stability.
And don't just picture the Fed as one big building in Washington, D.C. It's not. It's actually a decentralized network. There are 12 regional reserve banks spread all across the country, as you can see here, and each one serves its own specific district.
So what's their ultimate goal? You can boil it all down to this one sentence. The Fed's main job is to keep the U.S. economy stable by managing the nation's supply of money. That's it. Sounds simple, but it is incredibly hard to do.
But what does managing the money supply actually look like day to day? Well, one of its most important, kind of behind-the-scenes jobs is something you've probably used without even thinking about it. The Fed acts as the nation's check clearing system.
Let's just follow a single check to see how this works. Say a buyer in Maryland pays a seller down in Texas with a check. How does that money actually move? While the seller deposits the check in Texas, their bank sends it to the Federal Reserve Bank of Dallas, and then the Dallas Fed talks to the Richmond Fed to pull the money from the Maryland bank. The Fed is that essential middleman making sure trillions of dollars get where they're supposed to go.
Okay, so the Fed manages the plumbing of the whole financial system, but it also has to steer the entire ship. And to do that, it uses what you can think of as its 3 magic levers.
This is the big question, right? How does this one institution, using just a few tools, actually influence an economy worth over $25 trillion?
This table. This is the key to everything. These are the 3 main tools. First, you've got the reserve requirement. Just think of it as a rule for banks. You have to keep a certain percentage of your money locked up in your vault. If the Fed raises that percentage, banks have less money to lend, which cools the economy down. Second, open market operations. All this means is the Fed is buying and selling government bonds. When it sells bonds to banks, it's like a vacuum, sucking money out of the system. When it buys bonds from banks, it's like a fire hose, spraying money in. And finally, there's the discount rate. That's just the interest rate the Fed charges banks when they need a short-term loan. If the rate is high, banks won't borrow as much. If it's low, it encourages them to borrow and lend more money out into the economy.
And why is it bothering to pull all these levers? Well, it's to fight these two economic monsters. On one side, you have inflation. That's when there's too much money chasing too few goods, so prices for everything go up. On the other side is deflation, the opposite problem, where there's too little money and prices start to fall. That might sound good, but it can cause the whole economy to just grind to a halt. The Fed's job is to steer us right down the middle, a safe path between those two.
Okay, so this is all really fascinating theory, but the most important part of this whole story is how it all connects back to you, to your wallet, and to your life.
There is a direct pipeline from the Fed's decisions right into your bank account. When the Fed lowers interest rates to get the economy going, that's when you see those cheaper loans for cars and homes. But when they raise rates to fight inflation, yeah, borrowing gets more expensive. But there's an upside. You'll probably earn more interest on the money sitting in your savings account.
So let's just be crystal clear. Why does the Fed matter to you? Because its decisions directly influence the interest rate on your credit cards. They affect how much money you earn in savings. They determine how much it costs you to buy a car or a house. They help control the price of your groceries. And by trying to keep the economy stable, they play a huge role in making sure jobs are available. Their world really is your world.
The goal has always been stability. But in a world that is changing so fast, with digital currencies, with a global economy where money flies across borders in an instant, it leaves us with a final, massive question. Can one institution, even one as powerful as the Federal Reserve, still really hold all the levers? The answer to that is going to shape the next chapter of the money machine.